Working capital is not only essential to the survival of your business, but is also a key metric used by surety companies in determining your bond capacity. I'm Jessica Krause with New Life Accounting, and this is Build What Less. So working capital measures whether your company can pay off its debt within a year. This formula is going to be your current assets minus your current liabilities. And when your bond agent is working with that surety company to increase your bond capacity, they'll be looking at working capital as the guide to determine that total bond capacity. Typically, they want to see a subcontractor having a 10x factor, which means that their total annual revenue would be 10 times their working capital. If they're looking to do $10 million in revenue, they would need a working capital of $1 million. GC may have a larger factor, maybe 15 to 20x factor. So if they are looking to do 10 million in annual revenue, like the subcontractor, they may only need 500,000 in working capital as opposed to $1 million. So let's talk about what makes up that working capital. As we talked about, the formula was current assets minus current liabilities. So what is included in current assets? You have your cash accounts, contract receivables, retention receivables, inventory, short-term investments, prepaid expenses, and underbillings. In your current liabilities, you're going to have accounts payable, your line of credit, accrued liabilities, any unearned revenue, so deposits that you may have received from customers, or overbillings. But the surety could discount some of these items for the working capital calculation that they're using. So AR over 90 days could be discounted, related party receivables, certain types of investments, prepaid accounts could be discounted. So you want to make sure that you understand what your surety company is discounting when they are determining your bond capacity. So content is worthless without action. So some action items to help improve your working capital numbers would be looking at financing your equipment as opposed to paying for cash. Even if you have the cash, you feel like you have the cash, cash is going to decrease those current assets, where financing is mostly on the long-term liability side is not part of that working capital equation. You also want to make sure that you're billing correctly. So your billing is going to increase AR. But we don't want AR to be over 90 days because that may be something that's discounted. So we want it timely. We want to get it paid timely. We want a flow going through your AR that's helping you increase your current assets. And then sell any excess equipment that you have. This is also going to help increase current assets. So if you have a bunch of equipment just sitting around, you're not using, this is pretty common in the construction industry. You might look at selling that to increase your cash. And it could be maybe you have a little bit of a loan left that's hitting that current liability. And that is impacting your working capital as well. So selling that equipment would boost your current assets and decrease your current liabilities, which would really help. And then just strategically use that long-term debt. So if you know that your company is needing help with that bonding capacity and improving your working capital, let's chat. Schedule a time to chat with us. We'd be happy to see how we can help your construction business. I'm Jessica Krause with New Life Accounting, and we're here to help you build what lasts.